and welcome back to the Mind and Money podcast. I'm Sherry, a financial coach.
And I'm Val, a financial planner. And today we are talking about a topic that is hot all around the world, I'm sure.
Coming in hot.
But especially with our clients. So Sherry had a client last week. I've had numerous clients, but this is essentially the situation that we're hearing. This client was wondering, should she diversify her investment portfolio geographically? So in terms of her portfolio, whatever she holds in there, she holds a larger amount of US, which is not uncommon.
Yeah, I think that's pretty common. So she's actually based in the US. The question was, should she go more non-US investments? Because there's just that apprehension about, the US is a bit of a debacle right now with unpredictable markets, but then also the things that are making the US unpredictable markets are also impacting international markets. So
right. It's the ripple effect. There's no safe space in the active market other than like a high interest savings or a money market, but then you're not in the active market, in my opinion. You're sitting on the sidelines, holding out, waiting for the storm to pass, essentially. Markets are cyclical. We have seen ups, we have seen downs. However, there is an interesting element / leader that
interesting. I'd use other words.
Yes, that makes different pieces of the market behavior a little more uncertain. So all of this, I preface that this is not direct investment advice for you to go in action with anything financial. The first thing is it depends. It depends on your situation. It depends on your timeline, your risk tolerance, and your values as well, because that's coming into play more and more. We're seeing it at the grocery store. We're seeing more Canadian flags on products. We're doing a little bit more research into the root of where something comes from, i.e. Sherry's amazing curl foam gel.
I don't want to talk about it.
She doesn't want to talk about it, but we're looking at where it comes from, where it's sourced, because we're wanting to support more close to home. So for us, that's Canada. For this client, that's the US. However, with her investments, where the US has typically been strong. And I have clients that are moving more to the US. I have clients the majority of clients are staying put. So new money might be going into somewhere safer, or it might be going somewhere else. In this situation with this client, if she wanted to diversify further, I wouldn't necessarily say move some of your down investments right now, but any new money that goes in, maybe we explore going more foreign, more international, more Canadian.
Yeah, and even though she is based in the US, our views are very aligned. And
yes.
Despite being a US citizen, she's not in the let's go more US. She's like, fuck the US. Every day there's something that's happening that's going completely against her values and beliefs. So she wants to support, there's two intentions, right? The intention of long-term impact on her retirement planning.
Right.
But also, if she can invest outside of the US and still see the growth and still be able to hit her retirement goals, then that's win-win for her. And we don't have a crystal ball.
It's broken. And I said that so many times in client meetings last week is, unfortunately, it's broken. I really wish it wasn't. History does tend to repeat itself. However, when we're in it, it feels very fresh and like we've never been here before.
Right. And yeah, if you look at the markets year over year, if you pull back and look out, the further out you pull and the longer time period you look out, the markets do trend up over time. But the more you zoom in, the more ups and downs you'll see. And yes, it feels like, well, I'm a little bit older than you, but it feels like my generation, I'm technically Gen X, but only barely. I like to call myself a Zennial, anyways, because we're right on the cusp, but it feels like we've lived through so many once in a lifetime things.
Right.
Damn, we're resilient. And I don't want to be this resilient anymore. But also,
I'm tired of this.
I follow a creator on Instagram, and I love how he posts about things, and he some of it is clickbaity, right? Mm-hmm. What you should be doing in the current markets. And the next slide is nothing. Just leave your shit alone.
And that's 99% of my client conversations because of their timeline, because of how we're invested. When we invested a year ago, 5 years ago, the goal and the parameters are all the same. Nothing has changed other than the markets. And we start to get a little emotional, which is human. So then it's just the guidance and the coaching through of do not jump out of the roller coaster just because we're going down.
Yeah.
Stay in for the climb.
And you haven't ever really lost money until you withdraw and take money out of your investments. And maybe you've been taught an unfortunate life lesson with this because the markets have been really good the last couple of years, which might have tempted some people to leave things invested in ETFs, mutual funds that they needed in the next year or two. And the harsh reality is that things that you need within, I don't know, less than 5 years, definitely less than 3 years, like should not be invested. It should be in something safe, something with an interest rate that is predictable, something that you know you're not going to lose your investment in the capital that you put in. Because if you've been investing and saving for a home down payment and this was the year,
yes,
your chances are that's pushing out your purchase date because of the significant dip in the market. And the other thing that I like that this creator shares is he shares a lot of situations about how timing the market is never the best strategy because you never know when it's bottomed out and you never know when it's at its peak because we don't have crystal balls and nobody's ever going to be able to have a crystal ball.
And even to like within the last 2 weeks, there was a leak of a rumor that the tariffs were being paused. Markets went up 12%. And then it was a rumor. And then 2 days later, right? So we could have never predicted that rise. We do not know.
Follow somebody on social because apparently he's spilling the tea, but I don't trust him as far as I could throw him and I couldn't pick him up.
That's the piece. To Sherry's point, we don't know when the bottom is. It's like a freight train. You hear it coming, and then to try and time the market is to try to get on that train as soon as it passes you.
You'll die.
Yeah. You miss it. So dollar cost averaging is huge. To be putting money in consistently and trusting the process. It's like going to the gym. You show up, you trust the process, or working out, whatever it is. You don't just do a 6-hour workout and expect it to all show progress. That's like trying to time the market by doing it all in one day and putting all your money in and being like, yep, this is going to be great.
So if you've been putting money in every pay, every 2 weeks, every month, just keep doing that. And based on, I'll see if I can find a post and maybe link it in the show notes. But based on historical results, that is your best bet, is the consistency of putting money in regularly. Because he actually like zooms out and says like, he'll make up like 3 fictional people and say like, this person invested this much and they invested it every week, month. And then this person, I love the names that he gives them to. It's very comical. This person timed the market, was trying to time the market, and they
missed out.
Well, he'll do both. He'll do this person time the market based on the best. They bought
to
all
the days.
the dips.
Yes.
And then this person timed the market and they did the shittiest job timing the market. And then he actually looks at these 3 different people and what they would end up with in retirement. And the dollar cost average, the consistency
always wins.
Because when you're trying to time it and buy the dips, that means that there's a longer period where your money's just sitting there and not gaining anything because you haven't invested it. And also, I know we've talked about this a couple of times before, but check your investment accounts and check to see that the money that you're putting into it is actually getting invested.
Just sitting in your TFSA.
Yeah.
Or your RSP.
Because like you put the money in and then you invest the money, especially if you're doing something self-directed on your own.
Yes. Self-directed is like that. If it's typically managed or set up with a financial planner, it typically should be going directly into the market. But
so if you're feeling apprehensive about the markets and you are investing with a financial planner, reach out to them and book a meeting and just have that touch point and let them know how you're feeling, especially if that has changed. And even if that meeting is just to get some assurance that, keep doing what you're doing. And if you don't trust that person that's managing your money, that's a red flag. If you don't feel comfortable booking a meeting with them and having a conversation and sharing your views, that's a good indicator that you need to look for somebody else because you need to trust the financial experts.
Or if when you share those views, they're not validated. I've seen that a lot too.
They're making you feel like a dumbass. Run.
Yes.
Run. There are enough people out there wherever you live that will, like, there's the person for you that's going to trust and support you and make you feel the ability to be open and share exactly what's on your mind with them and get your questions answered in a way that you understand the answer.
So when it comes to this client, it really depends. If she wanted to broaden her horizons and diversify out of the US, then I would currently recommend not knowing a lot more about her. The new money, putting that into a different geographic area, somewhere else on the map.
And ultimately, the decision was that she does have somebody that she's working with, is to reach out to that person and have a chat with them and just get some guidance and advice. And yeah, if you're investing and if you've just started to invest on your own for the very first time in 2025, take some deep breaths and think you are buying the sale. Again, we don't know how low things will go, how high they will go this year. But just be cautious. And if you've started investing the last couple of years, you've probably been thinking like, yes, I rock. I'm going to be a financial planner because I'm obviously really good at this. You maybe have been humbled a little bit this year, but just stay the course.
Talk before you take action. And I don't mean like there's so many of my clients are like, well, so-and-so at work said to buy this. So-and-so said to do this. In the lunchroom, they were talking about this. My brother-in-law really is into this. And he said that. Make sure the advice is suitable for your situation.
And if you're investing on your own, you can be more pulled to these things that other people are saying. But
yes,
when you start to invest, or if you started and you didn't take the time to do this, write down what the goal of your investing in and write down the different things that you're choosing to invest in and why you made that decision to invest in those things. Because then when shit goes crazy, you can go back and look at that and see, okay, I was invested for this one for high dividends, this one for more stable growth. Like, you can see what the purpose of each investment choice that you made to give you clarity when you're thinking about possibly making changes.
Right. And that's more that self-directed route. But just like Sherry said earlier too, you're not losing out until you sell out.
Yep, exactly.
And it's the same saying that a lot of my clients have been saying, but it's easy to say it, but then to actually action it if they have spare money to put into it is when everyone's running from the markets, run towards them because it's on sale. So, and we're buying a dip. Is it the dip? Is it the bottom? Is it the cheapest it's ever going to get in this volatility? We have no idea.
Nobody knows.
No one knows.
So just be patient. Try not to look at your investments if you know you're prone to rash decisions when you're looking at them.
Yes.
And just deep breaths if you do look at them, but know that ideally you've got some time and that things will recover, but we don't know on what timeline. But just take a beat, talk to a financial professional if you've got somebody manage your investments, and just deep breaths. There's enough shit going on in the world right now. You don't need to be stressed out about your investments. If you are stressed because retirement is soon or something is soon and you've got caught in the dip, just reevaluate and adjust your timelines.
Yes. And check that strategy of how much I typically go over the next 24 months. What's needed? Is it in a safe place?
Yep. The stuff that you need soon needs to be as safe as possible, so it's not going to be impacted by the ups and downs of the market. So trust the process, trust your financial professionals. If you don't, run, find a new one, and just be calm. If you haven't made meditation a part of your regular day, maybe now's the time to start, because the world's crazy and our brains are busy, and meditation is incredibly effective,
and
unfortunately.
Stay informed, but please limit your media and news consumption.
Try and find that balance between being informed and being overwhelmed.
Yes.
Easier said than done, but just if you feel yourself at the tipping point where there's just too much going on, then just go for a walk, put some music on,
disconnect, get outside,
watch the show that you like to watch on repeat. Friends, Grey's Anatomy. Is that just me? Anyway, so if you've been worried about your investments, just be patient with yourself, be patient with your investments. Things will recover. Zoom out, look at the long-term market, and you'll be okay. And we are glad you've been here, and we can't wait to see you next time on the Mind and Money podcast.